You are listening Financial Intelligence by Berman and Joe Knight with John Case. You don't need to be a CPA to succeed in business, but financial literacy is absolutely essential. Understanding numbers and their role in corporate decision-making becomes crucial when you want to make smart, data-driven choices. Financial savviness helps whether you're contributing to company strategy or considering starting your own venture. Let's break down one fundamental tool: income statements. These financial documents can seem intimidating at first. Balance sheets, cash flow reports, return on investment calculations. Where do you even start? Income statements provide the perfect entry point. Think of them as a company's financial report card, showing revenue, costs, and profits over a specific time frame. Together with balance sheets and cash flow statements, they reveal a business's financial pulse. Real income statements aren't the simplified versions you see in textbooks. They can stretch across multiple pages, packed with detailed information. Why? Because they reveal much more than just profit margins. These documents expose operational efficiency, management effectiveness, underperforming divisions, and competitive positioning. So how do you extract meaningful insights from all this data? Begin with revenue at the top. This represents total money generated from products and services. Strong, consistent revenue growth signals a healthy business trajectory. Next, examine gross profit, revenue minus direct production costs like materials and labor. This figure shows what remains after covering the immediate expenses of creating and selling products. Gross margin percentages reveal how effectively a company transforms revenue into profit. Then review operating expenses, the indirect costs of running the business, including research, marketing, administration, and salaries. Public companies must detail these expenses by category. Watch for unusual spikes that might indicate underlying issues. Operating income, also known as EBIT, equals gross profit minus operating expenses. Operating margin demonstrates how much profit each sales dollar generates. Track these margins over time and benchmark against industry competitors. Interest and tax deductions follow next. Interest expenses are subtracted to reach pre-tax income, then taxes are deducted for final net income. Net margin expresses net income as a revenue percentage, showing true profitability. Watch for one-time items like asset sales or lawsuit settlements. These non-recurring events appear separately from regular operations and should be excluded when analyzing ongoing profitability trends. Stay alert for warning signs. Falling revenue, shrinking margins, or rising costs all suggest potential trouble. Compare current numbers against historical performance and industry standards to identify problems early. Don't skip the footnotes. Critical performance details hide in these small print sections. Footnotes reveal accounting changes, acquisitions, legal issues, and money-losing segments requiring deeper investigation. Benchmark against competitors. Analyzing rival companies' margins and growth provides valuable context for relative performance. Remember that size and industry differences affect comparability. Understand accounting methods. Aggressive revenue recognition or generous depreciation policies can distort results. Financial accounting standards exist to prevent such manipulation. Question major losses. Project failures or asset write-downs create significant losses. Beware of big bath accounting, where managers deliberately reduce asset values to minimize profits during difficult periods. Use ratios for perspective. Key metrics include gross, operating, and net profit margins, all measuring profitability. Return on assets assesses how well a company utilizes its resources. Project future earnings. Revenue, margin, and expense trends help estimate upcoming profits, informing investment decisions about whether stocks are fairly valued. Now for advanced analysis techniques. Scrutinize revenue recognition carefully. Accounting rules dictate when companies can record earned revenue. Revenue must be realizable and truly earned, not merely anticipated. Companies can still manipulate earnings through various recognition policies for upfront fees, subscriptions, and long-term contracts. Understanding these methods reveals revenue and profit quality. Remember that profit has multiple layers. Gross profit only considers direct variable costs, while operating profit includes fixed and overhead expenses. Gross margin helps compare production efficiency and pricing power between competitors. Operating margin shows overall organizational efficiency. Gross profit measures production profitability. Operating profit evaluates total business model effectiveness. Companies should maximize both metrics. Reducing direct costs improves gross profit, while streamlining operations boosts operating profit. Comparing gross versus operating margin trends over time provides deeper insight into profit drivers. Finally, remember this fundamental truth. Income statement figures aren't absolute facts but estimates and assumptions. Mastering finance means learning to create and interpret these assumptions effectively. Understanding basic accounting principles enhances your financial decision-making abilities. Learning to read income statements represents an accessible first step toward grasping business financial health and future profit potential. Found these insights valuable? Hit like and subscribe for book summaries that could transform your thinking. The purchase link for financial intelligence is waiting in the description, and we're curious, which of these concepts resonated most with you? Drop a comment below.